think the biggest problem a lot of people have is they have no idea what's going into their checking account, what's leaving.
Having the right setup for your cash accounts is probably one of the most important parts of like managing like the day-to-day.
People who maybe struggle a little bit with money management would benefit from something like having like a bill pay account and then also a spend account. So they know money in this account is for my bills only. Money in this account, I'm free to spend however I want.
They just throw a bunch of cash inside of one account. Well, that's like my emergency fund / travel fund / just random savings. You're like, oh, I go on a vacation and accidentally spent, well, it should have been my emergency fund. Welcome back to the show, everyone. Lauren and I are back for our weekly episode where we're talking all things money, from getting out of debt, budgeting, investing, and all the other crazy things going on in the world of finance. Now, Lauren, I had a quick story I wanted to share with you to see if you've had a similar experience. But the other day, my wife and I were driving home from the airport and, we were on the freeway and it must have been like a rock or a pebble or something hit my windshield. And, in the moment, I really didn't think anything of it. Like we got home, I didn't even bother checking. And then like 2 days later, I was just driving around running some errands and I see this crack coming up from the side of my windshield, like going up the windshield. And I was like, what the heck is this? So when I get home, I go out and I look at it and you can tell where, like, it must have been a rock or something hit the windshield on one side in the bottom corner and just this massive crack going across the whole windshield, starting to go up. And so it was just super frustrating. But I was like, all right, let me just call my insurance. So I have Progressive and I called them and they're like, well, you don't have like the windshield coverage. So it's technically like under your comprehensive. And so that's a $750 deductible. I was like, geez, okay. Like I can't be driving around with a cracked windshield. So I was like, all right, whatever. Like I filed the claim. They're like, yeah, we're going to use SafeLight. They'll repair it. You just go to the store and pay it there. I was like, all right. And so I was like, you know what, like maybe to make myself feel better, I'll just go on like SafeLight's website and just like request a quote. Just like, I'm sure it'll be like $1,000 or something and I'll just feel better. And I requested a quote, like typed in my VIN number and everything. And they were like, yeah, it's $450 if you pay out of pocket. And I was like, what the hell? Like I'm paying $300 more just to go through my insurance and it's going to have a claim on my record. So my premium is probably going to go up next time. And so it was just, I was super frustrated. I just called the Progressive. I was like, nope, canceled it, made a mistake. It was just a smudge on the window. Don't even worry about it. And I went directly through SafeLight. So I don't know. It was just super frustrating though. Have you noticed that like your insurance tends to be or can be more expensive than just paying out of pocket?
I haven't had to use my car insurance too much, but I did see like this TikTok not long ago about somebody trying to use their insurance for like a medical, whatever they were doing. And then apparently they said like they didn't have it and they compared the two costs and it was like drastically lower if they just paid like out of pocket as if they didn't have insurance. So insurance like marked it up and then they actually owed more and they were like, this is so confusing. I don't know why the world is like this, but yeah, I would have done the same thing. That's crazy. And the thing is, you know what, Nick? I probably wouldn't even have thought to do that because I would have been like you. Oh, it's probably $1,000. It's going to be a little discount for my insurance. When in reality, it's like, is insurance like actually a scam? Like this is crazy.
Oh, I was trying to just make myself feel better. I was like, all right, if it's over $1,000, like I'll pay $750, gladly, right? But it was like almost half the price that I was like, such a ripoff. And like, to be fair, like the comprehensive is also like, if you hit a deer or something, they'll cover that for $750. So I was like, all right, I guess like if the worse it is, the better that deductible is, but like it was just ridiculous. So, and I was like, you know what, of course, like we just bought the house last month and I was like, thank God nothing's been going on with the house, but of course like another expense in a completely random area of life just popped up and I was like, geez, that's just like, it's just frustrating, like just to have like a big expense popped up. But like, I think you had mentioned too, like when you first bought your house, there was like a massive expense that came up.
Oh, when we first bought our house in Pittsburgh. Well, I mean, we already kind of knew about it. Like when the owners left, they had one of those pod things that like sits on the driveway. And when they moved, they like tore a piece of the driveway out of it. And the driveway was just rough in general. So we were like, well, like we got like, I guess like $500 on closing day for that little piece. But we had to replace the whole driveway and it was $5,000 to do so. So like, yeah, that was like right as soon as we moved in because they took a huge chunk with them. The driveway was just not good anyway. And so we had to just like replace the whole thing. So yeah, I feel like when it rains, it pours. Like life just knows that you've taken on this huge expense and this big responsibility. And it's like, oh, let's just see how responsible you actually are. And it just gives you all these
I know.
different-
I'm not going to do anything for the next 6 months just to like minimize my risk of expenses. But no, I mean, that'd be silly. But, but yeah. Anyway, why don't we get into today's episode where we're talking about the 4 different types of money accounts that you absolutely need to have, at least in our opinion. And, you know, kind of building off of what we talked about last week, where it was like, you know, how to take your finances from good to great. I think the money accounts, like having these different accounts, is such an important part, especially as you want to level up your finances. You kind of want to have that room for you to like grow your money into. Now we're going to start off super basic with just like some of the cash accounts that we think you need to have. And then, you know, we'll kind of get a little bit more complex as we talk about the investing accounts, which again, it's just going to help you as you grow your finances. You want to have the different flexibility, and all of that's going to take place through the different types of accounts you have. But why don't we jump into this first one? So like I said, this first one are your different types of cash accounts. And, you know, I would say like, Lauren, tell me if you agree with this, but like arguably like having the right setup for your cash accounts is probably one of the most important parts of like managing like the day to day, right? Like having the right type of structure for how you manage just like your monthly cash flow. Like that's going to be such an important part of just keeping things organized. And you know, like the way I've always done things, the way that me and my wife do things together now is like we have one primary checking account. Everything goes into that account. Everything comes out of that account. And we kind of just run all of our expenses through that. But what do you think?
Yeah, that's kind of the same thing that I do. It's just, that's what I've always done. I've always been very good about tracking my expenses and kind of keeping that account flowing with like the what's coming in and what's going out. But you know, I think like you said, this is going to be like the foundation of, you know, the accounts that you have. Like, I think the biggest problem a lot of people have is they have no idea what's going into the checking account, what's leaving. So if you can at least get this set up, I think you're at least setting up yourself on a good foot to, you know, have a good plan with your money going forward. You know, so like you and I do a lot of the, you know, just the primary checking account, but I also think people who maybe struggle a little bit with money management would benefit from something like having like a bill pay account and then also a spend account. So they know money in this account is for my bills only. Money in this account, I'm free to spend however I want. If there's $500 in there, I can spend $500. If there's $0 in there, I can't spend anything. And I think that can really benefit people who just don't have that, you know, just who really aren't keeping track of where their expenses are going.
No, that's a good point. And it's almost like what's that expression? Like it's a silver lining, you know, cause like if you have too many accounts, you're adding just unnecessary complexity to where it's not helping you. You know, now you're like, you're going to have a harder time tracking your expenses because you got to look in all these different accounts. They might be at different banks with different logins, different apps. But at the same time, if you're someone who, you know, it has a little bit of struggles a little bit to keep things organized, having those actual separate accounts where it's like, hey, this one is going to be only for like, you know, the house stuff, like my rent, utilities, like those recurring bills that come up every month. Everything else is just whatever's left in this account. That's what I can spend. So like I've seen a lot of people have some success with that. Now, when I was thinking of like, all right, what are all the cash accounts I have? This isn't technically a cash account, but I think about it in the same sense. And I was hesitant to include this one, but having like a primary credit card. And the only reason I was hesitant is because I'm a big believer most people just don't know how to manage their credit cards well. So like recommending people have one of these, it's like kind of towing a fine line. But I do think if you're someone who can like responsibly manage your accounts, right? Like if you have a primary account, you know what's coming in, you know what's going out. You're like, you're not worried about your income covering your expenses. In my mind, cool. Then you should be using a credit card to take advantage of all the points. You know, like there's that extra layer of security. There's the added points for using it. It's also just in my mind, like the way I use a credit card is like I'll put all my monthly expenses on that card, you know, minus like rent or utilities, because those typically can't go on a credit card. Everything else goes on there, and then I just pay it off in full at the end of every single month. But I've always found, and Lauren, I think you're the same way, just having like one solid, like this is the main card I use for pretty much everything. Like to me, that's just been the easiest way to use it.
Yeah. And like you said, this is just another way for us to have like our cash accounts, because we use our credit cards as a debit card. And that's if you're using your credit card appropriately, that's how you're using it. As if it's just coming out of your bank account and you're just spending it on your credit card. Again, I like it for like the safety purposes, you know, if For me, I think, if you get some sort of like fraudulent transaction or something on there, it's a lot easier to call the credit company and have it like stopped or like replaced on your credit card than it is an actual bank. I don't know if you've ever dealt with it before, Nick, but whenever you have like your bank versus your credit card, it's like a lot easier to like recover the funds off there. Bank is a little bit different and it takes a little bit of time to get your money back in there. But yeah, I don't recommend credit cards for everybody. I'm not somebody who's going to be like staunchly like against or like, one way or the other, for them, against them. I really think it's going to depend on your situation. If you carry credit card debt each month and you cannot handle yourself around a credit card and you don't pay it off every month, I don't think this is the best thing for you. I think you're better off doing your bill pay account and your spend accounts and starting there until you get a better idea of what you can actually be spending and not going into debt for it.
Yeah, 100%. And like, I think I've been pretty vocal. Like when I first got into like finances, like I was very like hardcore Dave Ramsey. I was like, no credit cards, like even like to a point where like my credit literally was, what is it? Indeterminable or undeterminable. Like I didn't have a credit score because I just didn't have a credit history for like a year. And so it just went away. And like in my mind, and I will say it was so easy, like simple to manage your finances without, you literally just have one account, everything comes in and out of. And then like I heard, someone like was like, well, you're basically paying a fee to keep things simple because, having a credit card adds a little bit more complexity. But if you use it well, you can actually get some points off of it. In my case, like we use it for free flights, which is awesome. So like, am I willing to make that trade-off? I think for a lot of people, like I've seen them where it's like their finances run so much smoother if they don't have a credit card. Whereas if you are responsible, I think it's just like you might as well take advantage of it. In my mind, it's worth the added complexity of like having another account to keep track of if you can use it well, because, even if you use one that gets you like points or something, like my dad, he uses his credit card, gets a ton of like gift cards, which he always uses for like Target or going to Starbucks or just like miscellaneous stuff that those add up over time. It's a couple $1,000 at the end of the year, which is an awesome bonus if you're being responsible with it. But there was one thing I did want to keep in mind, or tell people that they should keep in mind when it comes to like having their different types of accounts, especially like cash accounts, because this is very common with checking accounts in particular, is keeping an eye on the minimum balance that's required in there. That's something so I use Chase for my banking, which for every other purpose, I love Chase, but their minimum balance that you have to keep in there is $1,500, which is just annoying. It's just an annoying amount. And I used to use Wells Fargo, which I know everyone always has like a gripe about Wells Fargo. I know you made the face. Everyone always says something about Wells Fargo. I literally, like, my mom set me up a teen account like however many years ago, and so like I just had always used it. But their minimum balance was $300. So that was super nice. And coming to Chase, I was like, this is just annoying. Like, why do you need $1,500 in here just to avoid a service fee? But that's one thing I definitely think people should keep in mind of. And then also like a zero buffer, having an amount of money inside of your checking account, especially if it's a bill pay account where you're like, I don't want to dip below that. Because if a bill comes up, you happen to forget about it or whatever, you want to have that little bit of buffer in there just to make sure. Lauren, what do you typically keep as like what I usually just call it a zero buffer?
Yeah. I back in the day when I was in my debt payoff journey and I was really down to the wire, I was keeping at least like 100 to 150. Now I've really buffed that up, and I prefer people to have at least $500 to $1,000 in there as a buffer. Right now I keep between like $1,000, $2,000 in there as a buffer, as my money's coming in and going out, just to make sure if something's coming out and I, whatever, it's not going to bump down below zero or anything like that. So, that's what I keep in there. One other thing I was going to mention, was, we talked about, finding the accounts where they, the minimum making sure the minimum balances are there. I also think it's important for your cash accounts. And, when you're thinking about your checking accounts, you get an account that doesn't have any fees or anything associated to it. I think there's a lot of people that just like, they'll have this fee that's coming out every single month and they're just kind of like, you just pay it, right? It's just like ongoing. But there's a lot of accounts out there where you do not need to be paying a fee. The accounts I've used my entire life, I've never had to pay a fee to have a checking account and a primary savings with them. So that's also something to keep a look at. And if you do, either call them and ask if they have an account that, you don't have to pay a fee on, or just simply switch banks. It is that easy to do that, and you won't be paying a fee every single month. So I think that's also important when you're thinking about where to keep your money, is making sure you're making a good decision on accounts that are free and you don't have to pay any type of fee per month to keep them open.
100%. I've heard a lot of good reviews of SoFi and Ally Bank. They're all, and then I think Capital One too, because it's all, they're all digital banks, you know, like they don't have any brick and mortar business or locations. I will say like the main reason I like Chase is because they have the business banking, which is super helpful. A lot of those online banks, they don't offer business accounts. So I'm like, I always let, you know, like you, I like to keep things simple. And so I'm like, if I can have one login for all of my banking, it's just less headache to think about, you know? But yeah, I think we can probably move on to the next one. So the next type of accounts that, you know, I think are really important for you to have is to have the right amount of savings accounts. And so just to be clear, like when we say savings accounts, this doesn't necessarily mean that it has to be like at your bank, just like a standard savings account. It just means like an account where you are saving money in cash, you know? But I think savings accounts really like they're twofold. One is to be protective, right? And then other types of accounts are going to be proactive. So that protective sense is like, are you saving enough money to cover future emergencies that may come up? And then you're also being proactive to cover any future large expenses that may come up. But I think, you know, the classic one when people think of having a savings account, of course, we're going to say is the emergency fund, you know, which that's one of those forms of a protective account, because it's going to make sure that any emergency that comes your way, you have enough money set aside for it. You know, the general rule of thumb is to have like 3 to 6 months worth of living expenses inside of here in cash. So if you're, you know, if it's $3,000 a month for you to cover all your bills, you're going to have anywhere from $9,000 to $18,000 in there. I will say what I found is for most people, even if like your monthly expenses would put, you know, your 3 months at under 10,000, I've always found having at least $10,000 in there, that's going to make sure that anything that comes your way, like you're covered, you know? And so just kind of beefing it up a little bit so you have at least 10,000 in there. I think that's a huge milestone for people to hit.
Oh, for sure. And to just, you know, bring it back to like where to keep, like what this savings account is. So I think a lot of people, you know, whenever they open their first checking account, you obviously get like the savings account usually with it. So that's where you keep your savings.
Yeah.
You know, in this financial journey, and you know what you'll hear a lot of people talk about are the high yield savings accounts. So that's actually something separate from your traditional type of checking account. So like you mentioned about Ally Bank, a lot of people like that account. And you can actually keep little buckets in there in your high yield savings account of your emergency fund, your sinking fund, things like that. So make sure you're actually break away from your traditional bank and move your high yield, or maybe move your emergency funds, your sinking funds into a high yield savings account and make a little bit of interest off of it. You know, we don't want to keep it at a bank and make 0.02%, like pennies. So pennies every single month. And I will say, I was somebody who clutched onto that savings account for a long time. And until I realized like, okay, I can move my stuff to high yield savings account. It's going to be okay. You just transfer it whenever you need it. So that's what I did. But yeah, it's quite a difference, you know, making a couple $100 a year compared to like 30 cents for the year is a big deal. So make sure you're moving it over there. Just wanted to say that about the savings accounts.
No, 100%. Like so I do have one savings account, which is I just keep a little bit of cash in, for any just miscellaneous purchases that come up. That way it's not sitting in my checking account. So it's never at risk of like, if I lose my debit card, you know, less cash in there is in my mind is better. But I literally at the end of the month, I'll get maybe like less than 10 cents worth of interest in there versus like, if you have a high yield savings account right now, I think most of them are between 3 and 4%, like 4% is $400 for every $10,000 you have in there. And so that can add up quick, you know? And so over the course of a month, you may be getting like $100 inside of that account every single month. It's just extra income, you know, it's literally free money that they're giving you for parking that money in there so that they, you know, they do whatever they do with it on the back end, but literally just free money in there. I think that's a huge plus. Now, I did mention that other type of savings account that I have. In my mind, I just consider a general sinking fund, but you know, I think another form of accounts that people should definitely have open is just sinking funds. And there's multiple kinds of sinking funds. So I always like to have like a general sinking fund where it's like, hey, anything random that may come up, whether it's like I need to get new tires or an oil change or like a yearly subscription that I don't really put into my monthly budget. I think that's a great use for it, but then also specific sinking funds. So things like travel funds or a home down payment fund, or, you know, if you want to start saving up for your next car, like having a specific fund, I think is super important. And then, you know, another thing that I think should be mentioned here, especially like, you know, we're talking about the emergency funds, the different types of sinking funds you could have, is making sure that those funds are all separate from each other. at least separate in your mind, you know? So like, Lauren, I know you had mentioned this in the past before. You have one big savings account, but you also have a spreadsheet that tells you, hey, when I look at this balance, I know that it's broken up into these, you know, X number of savings goals, which I think is super important. I think a huge mistake people fall into is they just throw a bunch of cash inside of one account. It's all kind of like, well, that's like my emergency fund / travel fund / just random savings. And it's like, you get, you know, something comes up, you're like, oh, I go on a vacation and I actually accidentally spent what should have been my emergency fund. You know, I think having that separation between accounts, super, super important.
Yeah, you'll accidentally spend your emergency fund on a trip to Hawaii or something. Yeah. So what we do is, now there are some, like I said, Ally Bank has a great high yield savings account. And a lot of people like it because it has that savings bucket feature where you can actually create little goals, like, you know, $10,000 for emergency fund. And you can see the money going towards that. In the whatever you want to create them for, you can do that. But I think like you said, a big issue is, and it was an issue for me before I started my whole money journey, was just anything that was in my savings account, in my traditional savings account that made 0.02% interest. Yeah. The problem was it was just all in the same bucket together, and I really had no purpose for it. So that's whenever I was like living on my own, and I was sort of digging into my savings a little bit to cover my monthly expenses. And that's where it was coming from, just whatever was in there. Yeah. So I didn't really have a, you know, designation between them. But now we don't have the Ally account, like I said, I like to use the same kind of company for everything. So we don't have that one, and it's not split up like in the actual account. So we actually have a spreadsheet. Every time we put something in there or take it out, we go to the spreadsheet that I share with my husband, and we put it in the right column that it goes into. So we have our emergency funds, we have our travel fund, we have our house fund because we're getting ready to buy a house early next winter. And then we also have, like, you know, our kind of our individual sinking funds. Cause like I told you, Nick, everyone knows we don't share bank accounts. So when we're transferring our money in there, it's coming from separate. So we just sort of throw it into our own pot if we need to mix those, and that's totally fine. It's just kind of like for our purposes of like where it's coming from. But yeah, that's kind of how we keep ours separate and kind of how we do our savings accounts.
All right, taking a quick break from today's episode, Lauren and I have some exciting news we'd like to share with you. If you're feeling stuck with your finances and don't know where to start, we have you covered with our one-on-one financial coaching.
These are no strings attached coaching sessions that you can sign up for today. No ongoing commitment. You simply book a session whenever you need one.
Each call is 90 minutes, and by the end of it, you'll have a clear budget to work with and a solid plan to start paying off your debt. Plus, we'll make sure you walk away with some awesome tools to keep you on track, including our budget dashboard and expense tracker, as well as our debt payoff optimizer.
And the best part, you'll get to work with both of us on the call. Together, we'll help you develop the best possible strategy forward, answer your questions, and make sure you feel confident about managing your money.
So if you're ready to get a handle on your budget and kickstart your financial journey forward, check out the link in the show notes to book your first session.
We can't wait to get started with you. Now, back to the episode.
Now, I guess question for you. You had mentioned this, I think, last week. Is there now a new line item in that savings account for Eddie's Ford Raptor that he wants to buy?
Not yet. Here's the thing, Nick. So whenever I bought my, I think I mentioned I bought my Honda CR-V in the fall. That was my car. I drove my Civic for 170,000 miles, and then decided that, like, now that I'm living a few states from home, like, I wanted something a little more, not that my Civic wasn't reliable, but I wanted something a little more comfortable, honestly, to be able to travel home with, you know, for my dogs and all my stuff and things like that whenever I do drive home. And I remember looking at cars, and I was considering a Honda CR-V or a Lexus RX 350. It's like the you know, the nice SUV. I really, really wanted that one. You know, white with the red interior. And he was like, "You're not getting a Lexus. That's just crazy. Just get the Honda." Okay. But then whenever he told me this, I got thinking about that conversation, and I came back to him and I said, "So why is it okay for you to get the Ford Raptor? You know, what's the difference?" He goes, "Well, that's a truck." And I said, "Yeah, I get that. But what's the difference? Like, the Lexus is an SUV too, you know, like, I wanted that." So it was really funny. We don't have it yet. I think that may have been, you know, why couldn't we just get the regular truck? I don't know why we need the fast sports truck, but maybe soon it'll be a line item on there.
Hey, Ford Raptors are awesome, but I think a Toyota Tacoma, dude, those are super nice now. Super nice.
Yeah, I think that's what he'll end up getting someday. We're not going to be buying a $100,000 truck unless things drastically change for us.
Yeah, I mean, my dad is a huge Ford guy. He like has had Ford trucks his whole life, and I'm like, you should definitely look at the Toyota Tacoma or like the Tundra because they're not only cheaper, but they're gonna last you longer because his trucks only last like 100 to 150,000. Then he's got to like replace the engine. I'm like, that thing will have 2 or 3 Fords is equal to like one Toyota truck. I'm like, it just doesn't make sense, in my mind. Now I will say those Ford trucks are awesome. But I guess getting back into this conversation, we had mentioned like separating those funds and, if you're someone who has like, I don't know, let's say you have $5,000 in your saving, you're like, yeah, this is kind of like all my extra savings for the various different things. I think when you separate that, you're like, all right, a few thousand is for my emergency fund. Maybe some is for, goal number 1 and I have more money for goal number 2. You're like, oh man, now it feels like I have less because those accounts have smaller balances. It definitely feels that way at first, but I will say, after like a few months or even a few years of saving up towards those goals, now you're just going to see these pots of money that have like a lot more money in them. And I think it can be an easy way to feel like you have even more money than you really do because no matter what the goal is or no matter what that savings pot is for, maybe it's for like car repairs or whatever, like you always have a pot of money for something. And that's an easy way to feel like you always have money no matter what comes up in life. I don't know. That's something that I noticed that like after a few years of really being strict about separating my accounts and then funding those accounts, month after month, it was like, man, it feels like I have more money than I really do because I always have, a pot of cash for whatever I might need it for.
Yeah. And I think it's also just good for like, I think we talked about last episode, like having a goal, you know what I mean? Like you're actually seeing like money chipping away towards that bigger goal that you have.
Yeah.
I worked with somebody one time and she was saving up for like a vacation fund and she was like super excited every time she got to put more money into that and was like, wow, like I'm actually seeing progress here. You know what I mean? So I think that's a big difference too. You're actually seeing it, maybe it is taking a little bit, but you're actually seeing something go towards that goal rather than just like random money thrown into account that you're not really sure what it's used for.
100%. Now, I think the last thing I'll say about this is in my mind, and Lauren, tell me if you think differently, if this money is going to be sitting in cash for, some goal that is going to be within the next 5 years. So like 5 years or less, that's when I always tell myself, cool, I'm going to keep that in cash in a high yield savings account. It's probably safer to keep it in there because the market can just do wild things, just like we saw in like a month or a month or two ago, right? Like you can see the market does wild things from time to time. And so in my mind, if you need to have enough runway to make sure that even if the market were to take a dip, you want to have enough runway to where you could weather a dip, pull that money out still if you needed to. But if it's less than 5 years, I always keep it in cash. Now, more than 5 years, that's kind of when we get into this next level of money accounts, which are your retirement accounts. Now, your retirement accounts are probably going to be one of the most important types of accounts for building long-term wealth. And when we talk about money that you want to hang on to for a long time, if it's retirement money, you definitely want to be taking advantage of some of these retirement accounts. And, I think this is an easy way to make sure that you're getting some sort of tax advantage and that your money is working for you. And in my mind, like the simplest account that I think everyone should have, unless you make like an insane amount of income and you're past the income limits for it, is just a Roth IRA. I think that's probably one of the simplest accounts to get started with your retirement investing. Tax-free growth. You put in money that's after tax, but it grows tax-free. You can take it out after you're 59 and a half, and you can have access to all of that money completely tax-free, which I think is just a huge plus that not enough people I think have a Roth IRA. They just rely on whatever their employer gives them. They don't look at retirement accounts that they can set up themselves.
Yeah. And I don't think people even think about, being, or maybe some people can't invest outside of what their employer is doing. But, I have both the 401k and my Roth IRA. I love my Roth IRA. I feel like it's building up pretty quickly in there. And correct me if I'm wrong. I believe, not that I'm going to do this, but I believe you can actually take out your contributions to your Roth IRA without paying taxes on it. There might be like a 5-year-old, don't quote me on that either, but I know that you can, if you need to take it out of your Roth IRA, your contributions only, obviously not the growth, but, so that's a benefit to that account as well. But yeah, I have both the 401k, as well as my Roth IRA. I do not max out my 401k. I think it's important to go up to at least the match. But I'm, also kind of, I think we'll talk about this a little later, but I'm also investing in like a bridge account, which is just my taxable brokerage. So I know I don't want to work until 59 and a half. So I want to have that retirement account that I can pull out of and be able to, use that money but still have it in the market to be growing. So that's kind of what I have going on.
Yeah, 100%. I think most people are going to be familiar with a 401k because if you're a salaried employee, chances are you probably have access to a 401k, which is just an employer sponsored retirement plan. And a lot of salaried employees do have, like what you had said, is that retirement match or that 401k match, which is literally just free money. You might as well take advantage of it. I think, the common rule of thumb that we always say is match beats Roth beats traditional, where you're putting money into to take advantage of that match. If you have one applicable to you, you're maxing out your Roth IRA next, and then you're going back inside of the 401k. Beyond that, if you're able to contribute a high percentage of your income, that's when you can kind of start getting creative with the different types of accounts. But if you're not a salaried employee, and maybe you're self-employed, I think the alternative in my mind to a 401k is opening up something called a SEP IRA, which is just a self-employed retirement plan. And so if you don't have access to a 401k, but you can reasonably contribute more than right now, the limit's $7,000 per year, you want to have access to some sort of retirement account. If you're self-employed, a SEP IRA is like a perfect place for it. You actually have pretty high contribution limits to it. And again, if you're self-employed, you can set up the way your retirement contributions go. You can set yourself up with super high contribution limits with the different types of accounts you have. But I think most people will have access to a 401k. And I think almost anyone out there should be opening up a Roth IRA. But I think another one that's not talked about enough is an HSA. Now, not everyone can qualify for an HSA, but if you can, an HSA is an awesome tool because it's kind of like it serves three different purposes. One is it being just a health account. Two is it being a savings account. And then third is it being not necessarily retirement, but an investment account because your contributions grow tax-free, which is super awesome. It's almost similar to a Roth IRA in that sense, but you can have access to those funds to cover medical expenses, which is really cool. But if you can fund those medical expenses out of pocket, you keep all that HSA money in there, it can continue to grow. And then by the time you hit retirement age, you have a dedicated amount of money just to cover any medical expenses, which I think is a huge plus.
Yeah, because you're going to have medical expenses at retirement. Mm-hmm. Like there's no doubt about that. I was just talking to my mom about this, actually. She has an HSA through her work, and she was talking about going to the doctor and using money out of it. And I said to her, Mom, you should probably just, if you can afford to pay for, your medical expenses on the side, just continue to put that money in there. And I think her work actually, I think it depends on who your employer is, but I think her work actually puts some money in each year and then she can put whatever she wants in there. And I told her, yeah, it grows. It's like, what is it? Triple tax advantage. So it goes in tax-free, grows tax-free, and then you can pull it out tax-free on, medical expenses that it, is good for. But that's definitely one that people don't think too much about. I think that's definitely more savvy financial move, but once you learn it, I think it can be such a good tool. I think I actually have one. I'll be honest with you, it's sitting in the envelope over here. I've not looked into it yet. I haven't done anything with it, but that's something that I need to start working on too, because of course, medical expenses are always going to come up. So I think it's a super important account.
Yeah, that's the only thing with opening more accounts is you're going to have more paperwork, more logins, more complexity, but I do think it's worth the time as you kind of get to those upper levels of in your financial journey. Now, because we're talking about retirement accounts, I will say, kind of the standard rule of thumb that, we've always followed is that you should be contributing at least 15% towards your retirement. Now, one thing I will say is that 15% rule, like that's a minimum, and that's also assuming you have a long working career. Like you start investing in your, mid to early 20s and you work all the way up until you're in your 60s, like standard retirement age. 15% is meant to replace your income by the time you hit retirement age if you have that long of a runway. If you don't, that's when you're going to start needing to invest more than 15%, 20, 25% if you can. And then of course, if, like Lauren, you had mentioned, if you want to retire before you hit standard retirement age, obviously you're going to need to start contributing more earlier on in life. And so that's just kind of an easy way to gauge it. But you did mention a bridge account, which is another form of a money account, which I like to call just a non-retirement investing account. Really, it's just a taxable brokerage account, which I think is super important for everyone to have open. Even if they aren't necessarily using it yet, I think just having a taxable brokerage account is super worthwhile because it can serve so many different purposes. One, like you had said, is that bridge account where if you want to retire before 59 and a half, you want to have access to quote unquote retirement funds, you're going to need a pot of cash that you can access penalty free, which is going to be a taxable brokerage account. Now, of course, you're going to pay income taxes on that money, but you're not going to get hit with that 10% early withdrawal penalty, which is a huge plus because that's 10% right off the bat. Like you're just going to save that money. But another reason why I like to have a taxable brokerage account is because as you get up to the higher levels of your financial journey, you want to start planning further and further out. And so maybe that's when a home purchase, 5+ years down the road, or buying a new car, or saving for, your kids' education or whatever. Like you want to have a place where you can let that money grow for more than 5 years, but less than retirement. That's exactly what a taxable brokerage account is for.
So you're saying that I might be able to have, or my husband might be able to have a Raptor someday if we put our money in there. Maybe he can take it out of that.
Hey, in 10 years, absolutely.
That's funny. Yeah, and I think it's important to mention. So, we talked about all these different accounts that you can have. Now, I think, those are just the accounts. It's not the actual investments inside the account. So like I mentioned last week, I think it was last week, I don't know at this point, my niece, I had her open a Roth IRA and she's been having, every month an automatic $50 goes into her account or whatever. And she has like $800 in there at this point. And I had asked her, like, do you have that invested yet? And she goes, no, I don't think so. So it was just sitting in cash, sitting in the account. So it's not going to grow unless you go in there and invest it yourself. So we went into her account and we invested in the S&P 500. And now she should be seeing some growth there. So yeah, just wanted to kind of call that out there.
100%. And especially now, most of the time now, if you have like an employer sponsored plan, like a 401k, when you sign up for it, they're automatically going to have you select an option, or it's just going to be a default option. So most people are going to be safe on that front. But yeah, you've heard the stories of so many people. They have a Roth IRA, they've been contributing to it for years, and then they didn't realize that they weren't actually investing. They're like, yeah, I'm investing into my Roth IRA. Like, no, it's just literally just a vehicle. You got to actually go in there and select the actual investments. But that's it's such a tough conversation if that's been after years of doing it. So definitely making sure that you're actually picking investments in there. But I did kind of mention something. So if you want, another type of account, again, and as you get up to those higher levels, you want to plan more and more out. And so, if kids is something that you want to have in your future, something like a 529 plan, which can be a super, super awesome option if you expect to pay for your child's education. Now, I will say I was having this conversation with someone. They're like, should I have a 529 plan, or should I just put that money into a taxable brokerage account? Or should I open like a custodial account for their retirement? They were kind of like, what option's best? Number one, I don't think like you have to choose just one and stick to it. But the other thing I is a worthwhile conversation is, especially as work and the economy is continuing to evolve, like going to college may not be in your child's future, especially if we're talking 20 years down the road, or it may even look different, right? Mm-hmm. Now I will say 529 plans, they do work for college and they work for education expenses, but they also work for certified trade schools, which I think is really awesome as well. Yeah. But maybe your child wants to be an entrepreneur, or they want to open up a business, or maybe they don't even plan to go to college, and so helping them buy a car is going to be something that's going to be something that can help set them up early on in life. I think having kind of that balance, like, maybe I'm going to contribute half the amount of money to a 529 plan, half to a taxable brokerage account that I'm going to just, in my mind, will be in their name, so that, your money is still growing. That's the important part. But then you have the flexibility with the different types of accounts. That's something that I've seen people do, is they have those different types of accounts, because you just don't know what your kids are going to, might want to do in the future.
Yeah, there might be TikTok University someday. You never know. They won't have to go to traditional college anymore.
Or they might be like, they might be a TikToker or a YouTuber, and they're like, I don't even need to go to school, and they're making $1 million a year,
Yeah, no, I think it's definitely changing in that front. So yeah, definitely can switch it up a little bit with how you're saving for your children, because we don't know what the future is going to look like. I think it's going to look a lot different than it does now, especially with all the people in like the student loan crisis. So.
Yeah, 100%. Now, I think the last thing to touch on is kind of like, when do these accounts become relevant to you? I think for most people, if they're trying to clean up their finances, really focusing on those cash accounts is going to be super important. 100% super important. As you start to have a better handle on like your spending habits, you're able to spend within a budget, having the right types of savings accounts are going to be really important as well, because you want to be able to build up that emergency fund. Make sure that you have the different accounts where you can set money aside for future expenses. Now, of course, that next level is going to be your retirement account. So once you kind of have that, in my mind, it's always like build up your foundation first, which is making sure that you can manage your money on a monthly basis. You can build up your savings. Then let's worry about retirement. Obviously that may change depending on your age, but let's say you've built up that foundation. Now it's going to be really important that you pay extra close attention to your different types of retirement accounts. And now once you kind of hit that 15% threshold, that's when I think, okay, I'm able to save 20, 25%. Now it's going to be really important that I look at different types of accounts to really maximize where my money is going. I think that's a super important conversation.
Yeah, Nick, like you said, obviously these are some important accounts to have as we're talking about them, but I don't think, if you're just starting to dig into your finances, that you need to go out and, open a Roth IRA, your 401k, all these different things. I think start at really probably start at the cash accounts and really understand your cash flow, like what's coming in, what's going out. Maybe set up your bill pay account and your spend account, and really get a good handle on that. And then you're ready to move into, your savings accounts and starting your emergency fund if you don't have one yet, and starting your sinking funds if you haven't done that. And then it just continues to build on each other. I mean, that's really how I sort of did it whenever I started my debt-free journey. Got in there, got in all of my expenses, then started going in, paying off my debt, started, building up my savings accounts after that. And now I'm really into the middle of investing and everything like that. So I think that it's important to just take it one step at a time. We're giving you this overview of what you can really do to maximize the accounts you have, but really you don't have to start, at the very end, or, start at the beginning and then work your way down, and you'll be on the right path.
100%. That complexity comes as you build your confidence, and you build your confidence with the foundations first. All right. That wraps up today's episode. And now one simple ask, as always, if you enjoyed today's episode, you found any value, the best way you can help us grow is by subscribing and sharing this with a friend.
Yeah. And if you want to have your money question answered on the show, you can visit our website, justanothermoneypodcast.com, and click the submit a question button. And don't forget to join us for another episode of Just Another Money Podcast.
The information, opinions, and recommendations provided on this podcast are for entertainment purposes only and do not constitute professional financial advice. Any financial decisions you make based on the content of this podcast are your responsibility. We strongly recommend consulting with a licensed financial advisor or other qualified professional before making any significant financial decisions. By listening to this podcast, you acknowledge that we are not liable for any financial outcomes.